Hello everyone and welcome to my channel. Compliance Lookup. In this video we will be learn money laundering and correspondent banking. If you have not watched earlier video then watch it first. These topics are essential for financial security. If you found this video helpful, don't forget to like, share and subscribe for more content on financial compliance, regulations and more. Now we start this lecture. Correspondent banking is an essential system in global finance. It allows banks in different countries like respondent and correspondent banks to conduct transactions on behalf of their customers. For instance, if a bank in India, that is, respondent needs to facilitate a payment to a bank in the US, that is correspondent for its customer, the respondent bank uses its account with the US bank to process their transaction. This helps local banks offer international financial services without needing to have a presence in every country. However, correspondent banking is vulnerable to money laundering due to the following factors. 1. Complexity. A large network of interconnected banks makes it difficult to trace where the money came from originally. 2. Cross-border nature. Transactions across multiple countries can obscure the true origin of the funds. 3. Lack of direct customer relationships. Correspondent banks do not usually know the customers of the respondent bank, limiting their ability to assess the legitimacy of the transaction. Example. Suppose a drug trafficker based in Colombia wants to launder $1 million. The trafficker opens an account with Bank X, that is respondent bank in Colombia, and deposits the money. Bank X processes a series of small transactions to different accounts in the US via its correspondent account at Bank Y, that is correspondent bank in the US. Since Bank Y has no direct relationship with the trafficker, it may not detect the illicit source of funds unless robust due diligence and transaction monitoring are in place. Now to coming to next topic, diligence on correspondent bank. Here we learn all subtopics in details. A. Scope of due diligence. To prevent money laundering, the correspondent bank must thoroughly assess the respondent bank's business and transactions. 2. Assessing transaction risks. First is types of transactions. Will the respondent bank be handling large wire transfers or trade finance? For instance, if the respondent bank mainly deals in cash heavy businesses like casinos, the risk of money laundering increases. Second is transaction volumes. Are large sums of money being moved frequently? Third is customer profiles. Who are the end customers of the respondent bank and do they present high money laundering risks? B. Regulatory actions. A. Increased scrutiny. Regulators globally have intensified their focus on correspondent banking relationships to ensure that banks are not used as conduits for money laundering. B. De-risking. Some banks have begun de-risking. They cut off relationships with high-risk countries or institutions to avoid regulatory penalties. For example, a European bank may choose to sever ties with a bank in a country known for drug trafficking to avoid the compliance risk. Now to coming to next topic. C. Establishing a new correspondent relationship. To establish a safe correspondent banking relationship, the following steps are taken. Here we will categorize in different methods. First is due diligence. Conduct thorough KYC checks on the respondent bank. This includes A. Ownership structure, who owns the bank, any suspicious shareholders. B. Business activities, what services does the respondent bank provide and to whom. C. AML compliance. Review the respondent bank's AML programs and past regulatory compliance. If needed, the correspondent bank might even visit the respondent bank to ensure compliance. 2. Approval of relationship. A. The relationship is subject to internal approval by the correspondent bank's risk, compliance, and legal teams. B. All due diligence findings are documented and stored for regulatory purposes. I. Parameters of correspondent relationships. A. Service limits. For example, bank A might limit bank B from conducting large value transactions exceeding a certain threshold without additional checks. B. Monitoring. The correspondent bank must monitor transactions in real time to flag suspicious behavior, such as a sudden increase in transaction amounts or transfers to high risk countries. D. Review of relationship due diligence. Ongoing monitoring. The correspondent bank should continuously track the respondent bank's activities. Next is periodic reviews. In this, assess the relationship at intervals to update KYC information and ensure the respondent bank remains compliant with AML regulations. Next is adjusting to regulatory changes as regulations evolve, so should the due diligence procedures. For instance, if a country is blacklisted for money laundering risks, the correspondent bank should reconsider its relationship with banks in that country. E. Independent Transaction Due Diligence. For high risk transactions, such as those involving politically exposed persons, PEPs, or non profit organizations, enhanced scrutiny is essential. For instance, a wire transfer from a non profit organization operating in a conflict zone may require additional checks to ensure the funds are not being diverted to fund terrorism. Real life example: HSBC Mexico's drug cartels in 2012. HSBC was fined $1.9 billion for allowing money laundering by Mexican drug cartels. HSBC maintained correspondent banking relationships with Mexican banks, which allowed large amounts of cash to flow through its US accounts without proper due diligence or monitoring. It became a conduit for drug money. This case highlights the vulnerability of correspondent banking relationships when due diligence is insufficient. In this example, HSBC failed to assess the risk posed by its Mexican correspondent banks properly. These banks were processing large cash transactions, which were a red flag. The lack of scrutiny and controls allowed illicit funds to be moved undetected, leading to one of the largest money laundering fines in history. Now, coming to next topic, Shell Bank. A shell bank is a financial institution that exists mainly on paper, with little or no physical presence, meaningful banking operations, or effective regulatory oversight. While they are legally registered, they are often created to exploit weak regulatory environments and can be used for illicit activities. Now we will take some points for better understanding. Money laundering risk. Shell banks pose a high risk for money laundering due to several factors. Second, lack of oversight. They are often located in jurisdictions with weak regulatory frameworks, which makes it easier for criminals to hide illegal activities. Third is anonymity. Shell banks can obscure the true origin and destination of funds, making it difficult to track who controls the money or where it's going. Fourth is limited transparency. They may not disclose critical details about their ownership or operations, which adds to the difficulty in tracing illegal funds. Example in real life. Let's say a criminal organization wants to move drug money into legitimate businesses. They set up a shell bank in a jurisdiction with weak ML regulations, e.g., a small island nation with lax financial laws. This shell bank doesn't have any actual branches or physical presence and employs only a few people to keep up appearances. The criminal group can then move money through this shell bank by transferring it between various international accounts. Since the shell bank is in a country with poor oversight, regulators or financial institutions in other countries would have a hard time figuring out that the funds are linked to illegal activities. Over time, the money appears clean because it has been passed through a legitimate looking bank. Real example. One of the most famous cases involving shell banks was the Bank of Credit and Commerce International BCCI, which operated in multiple countries with limited oversight. It was involved in money laundering, financing terrorism, and fraud before being shut down in 1991. Coming to next topic. FATF identified countries. Financial Action Task Force FATF. The FATF is an intergovernmental body that sets global standards for combating money laundering and terrorist financing. One of its roles is to identify countries with strategic anti money laundering combating the financing of terrorism deficiencies. Identified countries. The FATF identifies two types of countries based on their AML CFT risks. 1. Grey list. In this, the countries that have deficiencies but are working to improve. Financial institutions dealing with these countries must perform enhanced due diligence to minimize risks. 2. Blacklist. In this, the countries with severe AML CFT deficiencies that have not made sufficient progress. These are considered high risk jurisdictions, and financial institutions are advised to avoid or closely monitor transactions involving these countries. Correspondent banking implications. When banks maintain correspondent banking relationships with financial institutions in FATF grey or blacklisted countries, they are required to apply stricter due diligence. This may involve enhanced know your customer. Extra verification steps are needed to ensure the legitimacy of customers. Transaction monitoring, regularly monitoring transactions for any suspicious activity. Independent audits. Conducting periodic audits to review the integrity of the relationship. Example. Suppose a bank in the UK is processing international transactions from a bank in a grey listed country like Myanmar. The UK bank must take additional steps such as asking for more documentation, monitoring transactions more closely, and ensuring that the funds aren't tied to illicit activities like money laundering or terrorism financing. Next topic is exchange houses. An exchange house is a business that provides currency exchange services, allowing individuals and businesses to convert one currency into another. They may operate in both formal regulated and informal unregulated sectors. Now coming to some example. First is money laundering risk. Exchange houses are vulnerable to money laundering for several reasons. Second is high cash volumes. The large amount of cash exchange can make it easier to conceal illicit funds. Third is limited customer identification. Some exchange houses may not have strong know your customer procedures, allowing anonymous or fake transactions. 3. Cross border transactions. The international nature of their business makes it harder to track the flow of funds across borders, creating opportunities for laundering money. Fifth is mitigating risks. To combat these risks, regulators require exchange houses to implement robust KYC procedures, ensuring all customers provide verifiable information. Monitor transactions, tracking large or suspicious transactions and reporting them to authorities. Report suspicious activity, regularly reporting any activity that appears unusual or out of the ordinary. Example. An exchange house in Dubai handles large amounts of currency conversions for businesses and individuals. Criminals may try to use this exchange house to convert drug money into foreign currencies, intending to move it across borders without detection. To mitigate the risk, the exchange house must implement enhanced KYC procedures, conduct proper transaction monitoring, and flag any suspicious activity to local authorities. Now, coming to next and last topic, foreign branches. A foreign branch is a division of a bank that operates in a country different from where the bank's headquarters are located. First, money laundering risk. Foreign branches are exposed to money laundering risks due to A. Regulatory differences. AML-CFT regulations in the host country may not be as strict as those in the home country, providing loopholes for criminals. B. Distance and communication issues. It can be challenging for the head office to maintain effective oversight of the foreign branch's operations. See local corruption. Corruption in the host country can create additional risks for money laundering. Now come forward. Mitigating risks. To minimize these risks, banks should be A. Ensure adequate staffing and resources are in place at the foreign branch to implement AML CFT policies. B. Maintain regular communication and oversight between the head office and the foreign branch. C. Ensure compliance with local regulations and conduct internal and external audits to check for compliance issues. Example: a major US bank has a foreign branch in a Southeast Asian country. The head office in the US must ensure that the foreign branch follows local AML CFT regulations, even though those regulations may be weaker. To prevent money laundering, the US bank conducts frequent audits, ensures proper know your customer procedures are followed, and maintains open lines of communication with the branch managers. In 2012, HSBC's foreign branches were found to have weak AML controls, particularly in Mexico. As a result, drug cartels were able to launder money through HSBC's foreign branches, which led to a large financial penalty and tighter regulatory controls. So, we have completed this chapter of money laundering and correspondent banking. In the next chapter, we will learn about country risks. If you want to get updated of this topic, then please press bell icon of this channel. Thank you so much for watching this video.